I know, like,
You don't remember that.
So like, she tried to say one and didn't get very high. I got very tired. And I said, you know, stop it. You get tired. Like, let me be an intern for a second. I know, I'm like, yeah, but probably like, okay. I'll love that. I mean, I never have, I don't think. Yeah, I have a pre-planning and I agree. I am like always like on by yeah, I'm like yeah. That's why I'm like, I don't just leave.
All right. We're gonna get started just so we're not here too late. Thank you all so much for coming. This event is a combination of two of my favorite things in life. And so I'm really excited to be able to talk about taxes in the middle of eating pizza. So yeah. All right. I want to just talk about the scope of the presentation, if it works. Okay. So a lot of people thought we were gonna like do our taxes. Christoph asked if he should bring his laptop and stuff. But, I think it's just unfortunate timing that it's tax season. The goal is really to understand how income tax works, and that helps us optimize our taxes and pay less of them ultimately. I've updated all the tables and stuff and the number and the numbers in them to be specific for 2024, so the current tax year that just started. But really, like, the nitty-gritty details aren't the purpose. The purpose is just to understand how the whole system works and how we can optimize it. So these numbers will change from year to year. And there's a lot of like little small details that are only relevant to some people that aren't included in the talk. But this is just like a broad overview. And please interrupt and ask questions at any time. This is not formal. And if we don't finish, it's no big deal. And then I'll have an excuse to do it again. All right. So in the United States, there are 4 different taxes, generally speaking. So we'll talk about them clockwise from the top left. So the first two are what are called payroll taxes. So the Social Security tax is 6.2% of your income for the first $168,600 of income. So all of our income now is being taxed at 6.2% for Social Security. Then 1.45% of your income up to 200,000 or 250,000 if you're married is taxed for Medicare. And then above 200 or 250,000, there's an extra 0.9% added. And so we pay these top two taxes and our employer pays an equal amount. So they total like 15% if you add the like employee and the employer. And if you ever find yourself self-employed in the future, you will pay both of those portions. So something to think about if you have a side gig or something, it's usually heavily taxed. So those two are payroll taxes. The third is state income tax, and that really depends on the state. It could just be a flat rate, like 5% of all of your income is taxed. It could be like in Tennessee or some other states where we don't really have a state income tax, or a progressive tax system, which we'll talk about what that means in a second. And then finally, the big one is the federal income tax. I think that's the one that's like most in your control and probably most significant for most people. So we're going to talk about that today. All right, so we have a federal income tax system that is progressive, meaning the more income you have, the higher of a percentage you'll be taxed for it. So let's take a look at this tax table. This is for a single person filing their taxes. And we're going to come back to it many times in the presentation. So the columns tell you how much tax you owe for a given level of taxable income. And the rows represent tax brackets. So for each level of taxable income, there's an associated percentage that you pay, and that is your tax bracket. Your tax bracket determines your marginal tax rate. That's the tax rate you pay on the last dollar of income. So we have a demonstration to illustrate this, just for the people watching around the world. Thanks, Christian B. So if you think of this pitcher of water, this pitcher of water is all the money you make in a year. You're going to take this water and you're going to pour it into these 3 cups, which are not taxed, and we'll talk about them soon. And then the rest of it, try not to spill on the stacks table, will be poured into each cup. So each of these cups represents a tax bracket. So you pour into this cup until it's filled. So this money is taxed at like 10%. And then you move on to this cup. This money is taxed at 12%. And then 22. And that's as far as I've memorized. That's what's relevant to me. And 24. 24. All right. 32. And then 37? Yeah. 37. Man, we are so rich. 35. 35. Okay. All right. We're going to pretend that this is empty now. Okay. All right. So the last cup that we filled, this is our tax bracket, and this is our marginal tax rate. Only this amount of our money is taxed at this rate. The rest of our money is taxed at all these different rates. So there's 2 things we can think about here. One is the marginal tax rate. That's your tax bracket, your highest tax rate, the tax you pay on the last dollar of income that you make. The other is your average or effective tax rate, which is basically your total tax divided by your total income. Right, it's a percentage of your income that's going to taxes. That is obviously going to be much less than your marginal rate, right? Than the last cup you fill. Okay. The difference between marginal and average tax rate is a very key concept that we will come back to. But if this is the only thing you learn from the talk, then it was successful. Because understanding this difference will help you decide like which retirement accounts to contribute to. Okay. All right, let's do an example. So what is the tax due, the average and the marginal tax rates for a taxable income of 80K.
Marginal is 22%.
That's right. Yep. So 80K, we're in this range. That's our tax bracket. Okay. And then how would we calculate the tax due? What would the tax due be? Basically what's in here, right? This is the calculator part, but I've already done it, so you don't have to do it. So it'd be $5,426 plus 22% of the amount over 47,150. Okay, so we take 80K. This is the amount over that, right? And multiply it by 22%, add 5426, and that's how much taxes due. So $12,600. It's a lot. Yeah, we'll get it lower, don't worry. And then to calculate our average tax rate, we just take the tax we pay divided by the income, right? And so you can see the average is much less than the 22% marginal tax rate. This is not really our average tax rate because like I alluded to earlier, some of our money is not taxed. Some of our money does not count as taxable income. So how do we get from our total income or gross income to our taxable income? Okay, I already talked about this, but yeah, so the tax that's due is dependent on what our taxable income is. So the lower our taxable income, the less tax we pay. So if you don't want to pay a lot of taxes, it'd be a good idea to reduce your taxable income. Okay, so this is how we get from our gross or total income to our taxable income. We subtract three things. So those are those first 3 cups of water that are not taxed. One is health insurance premiums. This is like automatically deducted for us from our paycheck. And so it doesn't go on our W-2, so it doesn't get taxed. This is a pretty fixed thing that, you know, we have minimal control over. So we won't talk a lot about that. The next is pre-tax retirement account contributions, like for 403B or IRA. We'll talk about that in a little bit. And then finally deductions, which we'll talk about now. All right, so the deduction you take is a choice between either the standard deduction, which is a deduction that's available for every person, or itemized deductions. The one you're going to use is whichever is higher, because that's what's going to reduce your taxable income the most, right? So the standard deduction is just an amount of $14,600 that is available to everyone. So the first $14,600 of income is not taxed. And this is for single filers. For married, it's just double that amount. There's also a chance to use itemized deductions. And the only time you would use an itemized deduction is if it exceeds the standard deduction amount. Otherwise, you'll take the higher one, which is the standard. So itemized deduction is your state income tax. So if you were living in a state that had income tax, plus property taxes up to a maximum of $10,000, plus mortgage interest, no maximum, just however much you pay, plus charitable contributions. So if you add those things up and they're more than $14,600 or double that for married, then you'll use your itemized deduction instead of the standard deduction. So just putting it back in context. So we have our gross income, we subtract 3 things from it. The last one is deductions, and it's either the standard deduction, $14,600, or the itemized deduction. Okay. All right. So another example, we're going to calculate Christoph's taxable income. So 30-year resident, doing pretty well. He's making $70,000 a year. Let's assume we've already taken health insurance premiums out of this, out of that total, and he's not contributing to any retirement accounts. He doesn't have property tax or state income tax, but he contributed $10,000 to charity. Super generous guy. What is his taxable income?
Yeah, it's standard.
All right, a lot of numbers, but someone said use the standard deduction, right? Why use the standard deduction? Exactly. His only thing that he can itemize is the $10,000, right? So despite him being so charitable, he's not gonna get any special tax breaks for it because the standard deduction is still higher.
I don't think this is right.
All right, why not?
I'm saying,
Morally.
Morally, yeah. You get $10,000 in charity, you don't get nothing back.
So, if you had property tax or mortgage interest or
Yeah,
something.
but what if you're just a guy that lives in an apartment?
During the pandemic, I actually don't know if this is still going on, but they did like a $300 thing. You could deduct like $300 of charity.
Wow.
I don't know, to save the world from the pandemic or something. But yeah, for the most part, those $10,000, good for your soul, but not good for, neutral for your taxes. Okay, so to get to his taxable income, we take his, oh man, I wrote the wrong number. His gross income minus the standard deduction, and that's how you get to his taxable income. Okay. Trying to figure out which math. So it's 80. It should have been 80 on the back. All right, so taxable income of 65,400. What is his marginal tax rate? 22%, right? We're still in that row. 22%. Okay. And then to calculate his average tax rate, what would we do? Do this thing? Yeah, do math. Okay. So marginal tax rate is 22. We calculate his tax due. Okay, but his average tax rate, remember, we're gonna divide by his gross income, right? So his average tax rate is actually 11.8%. So pretty much half his marginal, right? So a lot less. Okay. All right. So far we're going through the things that reduce your taxable income. We talked about deductions, standard or itemized. Now we're gonna talk about retirement accounts, which is probably the biggest way to reduce your taxable income. Okay, so yeah, the way I think about these, they're a tool for reducing your taxable income. There are a couple different flavors of retirement accounts. There are individual retirement arrangements or IRAs. Those are accounts that you open on your own, separate from your employer. You just go to Fidelity or Vanguard or whatever you want, and you can open an IRA. And then there are retirement accounts through your employer. They're different ones, but they all essentially work the same, like 401ks or like we get 403bs because we work for a nonprofit. And then either one of these accounts, you can put in money that is pre-tax, which means it does not get taxed. You're taking from your gross income and you're shuttling it directly into the retirement account. Or you can pay tax on the money first and then put it into an account. That's called a Roth account. And that money is taxed now, but it's not taxed later when you take it out. Does that make sense to everyone? And the difference between the individual and the employer accounts? Cool, okay. All right, let's take a little bit of a closer look at the pre-tax versus post-tax situation. Okay, so like we said, pre-tax or traditional retirement accounts, the money you put in is not taxed. And what that means specifically is that we're taking, one second. We're basically taking money from the last cup and we are pouring it into our retirement account cup. And so what we save when we do this is our marginal tax rate, our highest tax rate. Okay? We're not saving our average, we're taking it from the last cup. We're saving our marginal tax rate. So for a lot of us, that's like 22%. All right.
And when we take it back, what is the rate you're gonna give?
Right, so when you take it back, it's gonna be taxed as regular income. So when we're withdrawing it, I think we can assume that we are retired. So all our money that we remove from these accounts are gonna go into this pitcher. And then we're gonna start pouring all the way from the first cup. Okay, so the tax we're gonna pay is gonna be our average tax rate, right? We're gonna start pouring into these cups, which are completely untaxed. Then we're gonna start at the 10% cup, then the 12% cup. Then finally we get to the 22% cup, which is what we save, right? And then we go on. So that's an important point. The money you save by contributing to a traditional account is your marginal tax rate. The tax rate you will pay in the future when you take it out is the average tax rate, right? I'll give an example. So, because a lot of, there's a big debate about what's better, traditional or Roth. Should we pay the tax now or should we pay it later? So just to go through Roth, we would pay tax on the money now, and then when we take it out, it's completely untaxed. In both of these accounts, if you invest the money and they make money, those earnings are protected until you take it out. Okay. So let's say your money now is like 4 seeds, and you're going to take that money and invest it, and they're going to grow into 4 big trees. So what's better, to tax the seeds or to tax the trees? So yeah, that's what a financial advisor said in a talk, and he was totally wrong. So, the answer is it doesn't matter, right? So let's say the tax rate is 25% and you tax the seeds. So you're going to end up with 3 seeds, right? And then they're going to grow into 3 trees. Let's say you didn't tax the seeds, 4 seeds, they grow into 4 trees, then you tax it 25%. It's the same, right? It's the same outcome. So if the tax rate is the same, it does not matter when it's applied. Does that make sense? So that's why I like traditional accounts, because the tax rate I'm saving is my marginal rate. It's not an apples to apples comparison. I'm saving the 22%, and then I'm paying an average tax rate, which might be like 11% or 15%. I would really have to fill up a big pitcher and a lot of cups to get my average tax rate above 22%. So I really like traditional accounts. And so at this point, you might be asking yourself, is a Roth good for anything? And yes, they are good for some things. Specifically with Roth IRAs, so this is the individual account you open. If you specify that as a Roth IRA, you can withdraw the money that you put in at any time for any reason without penalty. In traditional accounts, and in any type of like 401k, 403b, there's a penalty for taking out the money before a certain age. But with a Roth IRA, you can take it out at any time. So let's say like you might be buying a house, but you're not sure and you don't want to just like leave the money in cash or a checking account. You can contribute it to a Roth because it's still accessible to you. And specifically for buying a home, you can withdraw up to $10,000 of earnings if it's your first time buying a home from a Roth IRA. So you can withdraw everything you put in, and if that money has made money, you can take up to $10,000 out without penalty. So there is that kind of added flexibility with the Roth.
I have a question.
Yeah.
If there's no benefit for one versus the other, like tax wise, why is there like an income cap for the Roth versus not for traditional, or from what I'm aware of?
So the benefit is just what I was talking about earlier, right? So like there usually is a benefit for one over the other. It just depends on your situation, like which one you choose to. There is an income cap for Roth. Above a certain income, you cannot contribute to it at all. There's an income cap for traditional for pre-tax contributions. So above a certain income, you can still contribute to the traditional IRA, but you won't get the tax benefit. That is going to come into play on the last slide, the best part. Okay, so a little bit more into like the individual versus the employer accounts. So IRAs are available for anyone to open as long as you have a job and you have W-2 income. You can put a max of $7,000 a year into the account. And that can be Roth or traditional or a mix. Like you could do 3,500 in a Roth IRA and 3,500 in a traditional if you wanted. And because you're the one opening it, you can open wherever you want. So basically that means you'll have unlimited investment options because you choose where to open the account. Yeah. For the 403b, the max is much higher. It's $23,000 a year. But the options are a little bit limited. So like ours is with Fidelity. We have the investment opportunities that are offered through Fidelity. It's not like whatever we want, right? Okay. Any questions so far? Okay,
Actually, I have a question, and this might be a one, is it legal for your employer to mandate that you give money to your retirement?
that's a good question, because that's something I looked into earlier this year. The mandatory contribution is not part of this. This is a voluntary maximum. So another way to think about it is that's just extra money that they're putting in. It does not affect your 23,000 at all. So if you specify your thing as 0%, you'll be 0 out of 23,000. If you specify it as whatever, 40% or whatever, and you max it out, what they put in is on top of the 23,000. Yeah. And this does not include any matching. So if you have a job that has a full match, they will put in 23,000 on top of your 23,000 into the account for you. Yeah. Yep. Good question. All right, anything else? All right, Spencer's turn. So Spencer does some moonlighting. He makes a lot of money and he wants to know how much can he save on taxes. He does not want to pay taxes on $90,000. So same thing, we're just gonna assume that the health insurance premiums are taken out, and just for simplicity, we'll assume he's taking the standard deduction. So we gotta calculate his tax, right? We're gonna calculate his tax if he didn't contribute anything, and then if he maxed out his accounts and see how much he can save. Okay, so calculating his taxable income, we're just gonna take 90,000 and subtract the standard deduction. I think the math is right this time. It is right. $75,400. That's his taxable income. So we use the tax table, still in the same tax bracket, right? We're in this range. We calculate the tax due with the formula. He owes $11,640 in taxes. Okay. So what can he contribute to lower that? Traditional, what? Traditional 401k or 403b in our case, and
IRA.
an IRA. Okay, so he does that. He's gonna max out his Vanderbilt 403b, and he's gonna say that's not enough. I'm gonna open an IRA with whoever, and I'm gonna put 7,000 into that. Okay, so now what is his taxable income? So take his 90,000, the standard deduction, right? Because this is a separate cup. The IRA contribution and the 403b contribution. He has really lowered his taxable income. He's cut his gross income in half. In fact, he has bumped himself into a lower tax bracket. That's how much he's done. Okay. So now to calculate, yeah, and he's poor. We're gonna use this formula, right, to calculate his taxable income. So $5,216, down from 11,000 something. So he's saved $6,400 per year in taxes. That is incredible. And just think, when he's an attending, he'll be in a way higher tax bracket. He'll save way more than that. He could be saving 10,000 plus a year in taxes every year of his life.
Yeah.
So that is like literally worth hundreds of thousands of dollars over your career that you can save by just using these accounts.
And I guess the theory is that when he does pull it out, it'll be at the average, so it's still at the end of the day will save him, because when he does pull it out and it starts to get taxed, it won't be at that same tax bracket, it would be at the lower one now.
Yeah, that's exactly right. And we have a retirement example coming up that will show you some other things you can do in retirement to keep your taxes low. Yeah.
As an attending, you probably won't be able to deduct any pre-tax income, because you were saying that you'll be above the limit.
You're right. So this will be not available to you. This one will still be available. Yeah, and so you might be saving, 30+% of 23,000. Yeah, but yes, it is that. Yeah.
Why, like, why do you not have this?
Above certain incomes, you can't make tax deductible contributions to a traditional IRA. Yeah. Yes.
Big question.
A
Maybe
big
you'll have your
question.
case on this. At what point
should you be maxing out a like retirement savings account instead of paying off like extra to loans? That's a very broad.
Yeah,
We can talk after this.
that's a
but,
good question.
Like, would that potentially map out, or am I thinking about it wrong?
I think it depends on the interest rate on the loan.
Yeah,
If the interest rate is low, I would definitely stretch that out and contribute to these accounts first. If the interest rate is super high, you know, yeah, you're saving 22%, but like, it's
Right,
also
right.
good to pay off high interest debt and,
I mean, also it depends on if you're
Mm.
trying to do like public service loan forgive, like if you're trying to forget
Right,
your loans.
right,
should just
no.
right,
pay
then
as
you can
little
try to
or
defer
less
that, yeah,
possible.
yeah, that's a good question. yeah.
thank you.
There's a good resource related to that that I have on
There.
the last slide.
Yeah, we
Okay.
do this.
All right. Yeah, so this is incredible, right? I mean, what Spencer's done is incredible. And you might be satisfied. You might say, I'm ready to go home, but it gets even better. There's one more type of retirement account that I want to talk about, and that's the HSA or health savings account. So the HSA is really special because the contributions are not taxed, just like the rest of them, the earnings are not taxed, and the withdrawals are also not taxed. So it's like triple tax advantaged. On top of that, what you put into an HSA is exempt from both income tax and payroll taxes. So the Social Security and Medicare tax, you don't pay on that money. So what are HSAs? They're accounts that are available with high deductible health plans. So we have one that's offered to us. Obviously depends on your health situation, right? If you're expecting a ton of medical expenses, it still might not be worth it to do this. But if it is an option for you, you can choose the high deductible health plan, and then you can put $4,150 per year into the HSA. And actually Vanderbilt will put in like $750 of that for you, just as a gift. And then the way it works is that the money has to be used to reimburse yourself for medical expenses, but that can be done at any time in the future. So if I have a bike accident and I have a bunch of medical expenses, but I can cover them out of pocket, I can just reimburse myself for that when I'm retired as a source of tax-free money for me to fund my life as a retiree. So, so I use this and I just have like a folder on my computer of like medical expenses that every 6 months to a year, I'll just like put what happened into that folder. So if I get audited when I'm 70, I can just pull up that folder. Yeah.
One question,
Mhm.
so I have an HSA for my job.
Yeah.
Can she have one for hers, or is it only who has the medical insurance?
Is she on your insurance?
She's on my insurance, yeah,
Then probably she can.
through Vanderbilt. Or it would
You
be
work-
through my insurer, we'd have to open up an HSA for her under my insurer.
I would guess the latter, but I would double check with your insurer and say you want to open like a spousal HSA for your wife who's under the insurance.
Okay.
But it should be both of you, I'm pretty sure.
But Vanderbilt won't contribute to that, or they will?
Do you work for Vanderbilt?
No, I don't.
Then I don't
My
think they
employer
will.
does to mine, but I was just wondering if I was like missing out on hers.
I think the only possibility is if your employer would contribute to hers, but Vanderbilt won't because that's just Vanderbilt's like insurance plan.
Makes sense.
Yeah,
Got it.
yeah, but I would ask them about it.
Okay.
Yeah.
Will do.
Okay. All right, so so the HSA, special type of retirement account, if it works for you, you can use it and minimize your taxes even more. So what if you never end up with like that much medical expenses? Then it basically works like the traditional IRA where the withdrawals are taxed as income. Yeah, so it's not, you don't lose that money. All right. So let's say you're an attending, you're doing really well, you're maximizing these accounts and you're like, well, what am I gonna do with all my extra money? So you might want to like invest that money. And so to do that, one way to do that is to open a brokerage account where you can buy like investment funds and have that money grow in the brokerage account. And so obviously the money you put in is taxed. It's not a retirement account. It's just your income. It's going to be taxed. And then the money you make is also going to be taxed, but investments are taxed in a special way that we're going to talk about quickly. So the money you make in an investment is called capital gains. So capital gains are what you sell the investment for minus what you bought the investment for, right? So if you buy it for $100 and you sell it for 110, the capital gains are $10, and that's what you have to pay tax on. There are different rates for short-term versus long-term capital gains. Long-term capital gains are investments that you held for at least a year before selling. It's a little bit silly, in my opinion, to invest for short-term periods like less than a year. So I'm not going to talk about that tax. It's similar to like the regular income tax. But for long-term investments, there are these preferential rates for your capital gains. The most notable part is that there's a pretty solid range of taxable income for single or married people where the capital gains rate is 0%, right? And the way you figure out like which of these income brackets you're in, you take your taxable income, and then if you also sell investments and have capital gains, you add that back to your taxable income. So like if my taxable income is like, let's say I'm married and my taxable income's 94,000, but I sell investments and I've made, 1,000 in capital gains, then I'm in this bracket, right? But if I made $2 in capital gains, then I would still be in the 0%, if that makes sense. This comes up mainly like in retirement, where a lot of your income might be capital gains.
So your tax on your capital gains for also what your taxable income is outside of the capital gains?
Yes, so your taxable income determines your capital gains rate. Yeah. And your tax bracket and marginal tax rate. Any other questions? Okay. All right. Let's do one more example. This is the retirement example to see what taxes look like in retirement. Unfortunately, Claire couldn't make it. She was the example. So Dr. Lowe is going to retire, and she does not have a Roth IRA. So we're going to see what happens to her. She's worked for 20 years. She's maxed out her pre-tax retirement accounts. So 401k/403b and traditional IRA, except when she was over the limit. And then the rest of the money she invested in a brokerage account. So that'll be taxes, the earnings will be taxed as capital gains. She's married, so we're in the married box here. And then her and her husband live a lavish lifestyle when they're retired. They want to spend $120,000 a year. Even though their house is paid off, they don't have a lot of expenses. They just want to splurge, treat themselves. And on top of that, she doesn't want to pay any taxes. So let's see if we can help her out. All right. So what Dr. Lowe and her husband can do, they can take $29,200 from traditional accounts like their 401k or traditional IRA. That amount is the amount of the standard deduction. So that's one of those 3 cups. That money is not taxed at all. Okay. Then they still need another $90,800. So they're going to just take that from their own taxable brokerage account. That's going to be part principal, what they put in to their investment, and part capital gains, right? But even if we assume that it's all capital gains, how much tax will she pay on it? 0. That's right. Because we take, basically this is not taxable income, right? This is the standard deduction. So this is their income, and they're married filing jointly, so they're in here. So they're paying nothing on their capital gains, and they're paying nothing on what they took out of their traditional retirement accounts. So $120,000 of income and 0 taxes. I like this example because it just demonstrates that it's okay, like, not to have a lot of Roth money when you're retired, right? So a lot of people are like, when your income is low, contribute to Roth, because, if you have expenses and stuff when you're retired, it's not gonna be worth it, like the little tax savings you get now. But here, like, you can generate a decent amount of income in retirement and not pay any taxes at all, even if you don't have a Roth IRA. Any questions about this one? Okay. So let's say that Dr. Lowe still just wants that Roth money. Maybe they're gonna spend like 200K one year, really go crazy. How's she gonna get it? So like we talked about earlier, because of your questions, you cannot contribute directly to a Roth IRA above certain income limits. And you can also not deduct your contributions to a traditional IRA. But what you can do is you can still contribute to the traditional IRA. It's just post-tax money instead of pre-tax money. And then you can immediately convert it to a Roth IRA. That's called a backdoor Roth. And you can do this every year with $7,000 a year. And that money is accessible to you 5 years after you do it, even before the normal age of 59 and a half. So you do it at age 35, you can take that money out at age 40 if you need it for whatever reason. Yeah. So that's another reason why I like traditional IRAs now, because even if we don't put money into Roth right now, eventually we won't have the traditional IRA option, and this will be our only option. And so for years as an attending, you can be doing the backdoor Roth with 7,000 or 14,000 for a couple every year and still have a good chunk of Roth money in retirement. Any questions? Is this still exciting? Was it ever exciting? Okay. All right, so a quick review. There's 4 types of taxes in the US. Federal income tax is like the most significant and the most in your control. We use a progressive tax system. You can calculate how much tax you owe with the tax table that we referenced many times. Your marginal tax rate is the tax rate you pay on the last dollar of income, and the effective tax rate is your total taxes divided by your income. You can minimize your tax burden by reducing your taxable income. The biggest way to do this is with the retirement accounts and HSAs. And then you can take advantage of the standard deduction and long-term capital gains rates to live totally tax-free in retirement. So anyway, thanks for listening. This was fun. These are some favorite money resources if you want to learn more on this topic. If you are thinking like, this is really cool and I want to take full advantage of everything, but I don't care about it and I'm not going to remember any of it. This blog post, Hierarchy of Savings, is basically a list, an ordered list of what you should contribute to first, second, third. And it includes like, high interest debt versus low interest debt and, what 401k or IRA. It just has like a list in order, and you can just start at the top of the list and just you maximize number 1, you go to number 2. And it's like a really useful resource. Yeah, for sure. Yeah. Yeah. And it was recorded theoretically, so we have that too.
Oh.
Yeah. What's that?
You mean theoretically?
I mean, it probably worked, right?
You were trying to record?
We pressed the record button.
Oh, I see what you're saying.
Yeah. Yeah. Okay. All right. Well, help yourself to more pizza. Take some home. Oh, if anyone feels compelled to contribute to the pizza, let me know.
Oh, yeah.
No, it's totally optional. Yeah. Question.
Why are you so into taxes?
I did MD PhD, and during grad school, I like first got regular money.
Right.
And so I just like went into a deep dive about like how to invest it and what to do with it. And that led to like a whole bunch of other stuff, like how to be frugal and how to minimize taxes and all this stuff. So just
Little hobby.
yeah, little hobby. Started as an obsession. Now I think it's just a normal hobby. Yeah. Yeah,
I mean, every hobby starts off as an obsession. Right?
that's true. Yeah.
Do you prefer Venmo, or how do you want us to pay you for pizza?
Venmo works. Yeah. It's just Joseph-Elsakr, Elsakr. Yeah. Traditional, not Roth. Cool. That's okay. We did enough of that, I think.
That was wonderful. Thank you.
Thanks, Christoph. Thanks, guys. Elsakr.
AKR.
Mhm.
Oh.
Joseph is the first one.
Just think of it, she said, more than